good afternoon, everyone. We'll go ahead and get launched. Appreciate you taking time to join us for our monthly call. It's already halftime in the year, so we're in mid-July, obviously. It's been quite a year in 2020, so just as a reminder, our theme this year is vision. Greatness starts with a clear vision, and that's been, I think, troubling for many of us to try to articulate that, particularly these days in a very fluid environment. At least that's been affecting our calendar on a personal level and professionally as well. So just as a reminder, we will go through a recap of the last month. We'll highlight some of the ongoings of what we've seen. And I always try to put together something that I think is interesting in the current market conditions as well. So we'll get into that. And then at the end, obviously, if we have time, we'll grab some questions as well. But to get us going, we are recording these. Several people have asked us to do so, so we've obliged. So if there are people in your life that you feel would benefit from today's presentation or down the road, please lead them to our website. And these calls will be recorded, and they can play it whenever they would like to. First, I'd like to start off, last week we sent out how investors can keep their political bias from hurting their portfolio. So one of the observations, obviously, is we're in this very political environment, particularly local. The reason we also bring that up is there is an election occurring here in November. So we know that this is going to be one of those strong topics of interest moving forward. So just to let you know, we're here to bounce ideas off. Obviously, we cannot predict elections. We can't predict what the market's going to do, but we can certainly talk about observations of what's happening out there. Both parties have kind of talked about or starting to talk about what their vision of the future is going to be. So we'll continue to provide information along the way. Obviously, we often use third-party sources just to back up what the thoughts or general thoughts are out there as well. Wanted to talk a little bit about some of the market commentary of what's going on. So I guess the good or the bad news is that Congress was in recess, and they will be through the next Monday, the 20th. There's a lot of anxiety out there in terms of the constituents. Many of us, of course, are aware of the fact that at the end of this month, the $600 per week additional check for the COVID-19 for those on unemployment is set to sunset here. That's going to continue to be a topic, is what the next potential stimulus package potentially could be. Also in late April, the Budget Office forecasted a deficit for the fiscal year 2020 to be $3.7 trillion, or 18.1% of our $20 trillion economy. So that gets to be a rather staggering number when you just kind of zoom back and look at that. But that's, again, one of the things I think is appropriate and prudent from an investment point of view, is just to watch what's happening out there with these stimulus packages and the type of how the government is utilizing and the partnership with the feds, and how the feds prints money and ultimately is keeping interest rates very low. So one of the other observations we've had, again, this is coming from some of the information we try to send to you on Tuesdays in the By the Numbers, is the Take It and Spend It. So the CARES Act non-taxable distributions were $1,200 per individual and $500 per child if you were lucky enough to qualify to get that. So there's 159 million electronic payments, which totaled $267 billion. The good news is that all of those went out, and again, that's something that, as our friends in Congress get together here next week, there's a high potential they'll be talking about what the next stimulus could be. And then 45% of Americans in May of 2020 have living wills. Living wills document the end-of-life medical care. So I just want to highlight that. A lot of people have been asking us about estate planning, specifically living wills or those directives, and in this environment of how an event like COVID affects that. It'd be a good idea to crack open your estate documents, review who your power of attorneys are, and to review your directives, just in case, God forbid, something happens. You want to make sure that those are still in alignment with your current thoughts. So again, the last statistic here, number 4, 37% of 1,000 Americans indicate that they think the U.S. economy will fully recover within a year. 63% of those interviewed say it will take at least another year. So the good news is the majority of respondents are pretty positive about what's going to happen in the upcoming years. We've talked about that in our last calls, just again, if you remember the GDP and what the forecasting is there. But we think that this is good news long term, is that most people are pretty looking at this in a positive point of view, particularly in a multi-year market recovery. Lastly, the second quarter update. Many of us are experiencing what's going to happen, and there's still a lot of research going on in terms of how this virus is working and potentially mutating itself. But what I will say is that half of U.S. working age population, 206 million people, are not employed currently. So that's a concerning number. However, we do feel if again, that stimulus currently enjoyed by those on unemployment, if that goes away, there could be a potential of people now going out and back into the workforce. So that's a number that we'll continue to watch as well. And then on the right side, just wanted to point out, U.S. restaurants are still, the bookings are down. So again, just that think about this in terms of parties. Some of you may have been invited to a graduation party, a birthday party, a wedding party, anniversary party, things of this nature. Those can potentially be lifelines for restaurants. So again, this is, I think, a common sense of what's happening out there, and those are the observations, obviously, we're trying to bring forward. And yet many restaurants are also taking advantage of the carryout situation. So we'll monitor that, track that with and along this with you. So the road to the economic recovery begins as the world reopens. So that's one of the key questions today is as we start to flatten the curve, as people go out, what are their spending economics? What are the spending habits going to be in there? So the economist has dubbed the constraint of the 90% economy, meaning that the economy can only operate at 90% of its potential due to the efforts to contain the virus. It's a very interesting statistic, I think. So consumption makes up roughly 70% of the U.S. GDP. So as the consumer has a resilient force throughout history, 11% unemployment rate, continued risk of potentially deadly virus are extraordinary obstacles. So again, this is just that voice of caution. We've talked about this before of what's currently happening on Wall Street versus what we see happening in Main Street. And it's, again, I want to just highlight that consumption makes up 70% of the U.S. GDP. So that's why that focus on how a consumer spends money and when they spend it and how much is something that's going to be really important for all of us to track along the way. So again, on a positive side, U.S. economy activity probably bottomed in the second quarter, expecting a steep 35% quarter-over-quarter contraction in the GDP. So the current recession has seen a much sharper decline in economic activity as compared to the global financial crisis, the last one that we went through. So again, there is a sequential growth expected to turn positive in the third quarter. So again, that's a good sign. We want GDP, we want consumptions, we want consumers out there spending money. So we think that's an important area to be focusing on, is what do consumers do as they're able to go out and spend money, and what do they spend it on. Also positive news is that the spending rates soar in the economic turmoil. So a lot of people we've read, it's 32%, the highest record since the Bureau of Economic Statistics started in 1960. So the savings rate at 32% is really, really high, highest rate. So that's that can be good and bad. So again, it's something to focus on. Is, are people saving money because they're not spending it because they can't, or are they saving money because things are they're shoring up for the future, if you will? So the stimulus likely helped to drive about 18% month-over-month increase in retail sales in May, and is starting to stabilize the labor market. So again, that's important. We think the savings glut also has led to massive spike in money market fund assets, which according to the Investment Company Institute stand at approximately $4.7 trillion, well above the peak of $3.9 trillion in the last global financial crisis. So the good news is there is cash on the sideline. There's cash in the bank. We'll see how that works, but this is just a little pictorial graph of where the savings rate is currently versus traditional. So you can see it's definitely hit a peak. It's high. We'll see how that continues to flow, or if again people will get out there and spend money when they feel more comfortable. So stay-at-home beneficiaries, retail, trading, and digital giants. We'll talk about this in a minute. I wanted to pick up on this trend just to look at some of those companies referenced here. But the whole deal is just what's happening with the consumer. So we've talked about this before, but 2020 has seen a surge in online brokerage account activities, retail option trading, trading of fractional shares, retail investors bidding up, beat down stocks, sometimes bankrupt stocks like Hertz. Again, no sports, no problem. The trend being the number of positions held in Robinhood accounts. So these are your online accounts people establish, they trade on their own. Obviously has gone through the roof here the last few months. So again, those that we think are interesting statistics of people getting out there and investing their own money, and we're watching what's happening out there in the economy as well. But so a lot of the growth we'll talk about here in just a second. So U.S. equity is optimism and interest rates much lower, much longer. As discussed before, the Fed chair, Jerome Powell, a few weeks ago came out and said interest rates will remain where they are essentially until 2022. So we think that's a good stabilization, particularly in the bank market, the lending and credit facilities out there. So the Fed's balance sheet expanded from about $900 billion to $2.3 trillion in this pandemic. So the balance sheet ballooned from $4.2 trillion to $7.1 trillion. So that is an increase of more than double compared to what happened in the last global financial crisis. So since 2008, the Fed's balance sheet has grown by an astonishing multiple of 7 times. So what does this mean? It means that they're going out, they're buying government debt, they're taking on these tremendous assets, and then as what happened last time is as the economy gets better, they try to sell those assets back. So we should also note that U.S. government debt has grown from $10 trillion to over $26 trillion over that same period of time. So those are the numbers, again, that we'd like to bring to your attention, just to give you that peripheral or the 360 view of what's happening. So the monetary easing and low interest rates have boosted asset prices and financial returns, despite the markets being viewed by many as overvalued. So faced with a choice between a 0.7% yield on a U.S. 10-year Treasury bond or a 1.9% yield in the S&P 500, the decision is not difficult for many investors. So again, that's one of the things where low interest rates both have many pros and some cons as well. So looking forward, equity prices, and that typically the stock market bottoms before an economy does. During the second quarter, the S&P had its best quarter since 1998. So the S&P second quarter of 2020 had its best quarter since 1998. Yet GDP growth likely contracted by the most on record during that same 3 months. So again, it's that theme of what's happening, if you will, in the economy versus what's happening in the stock market. So that's just something that, again, we're paying attention to it. But the unevenness in returns over the past 4 years reinforce the importance of long-term investing versus short-term focus. And the repeated buying and selling could do more detriment than value creation. So again, as we've talked about before, investing should be viewed long-term. when you go to sell a stock, it's really about two decisions: when do you sell and when do you buy back in, if you will, if that's part of the strategy. And then the total return roller coaster ride, just kind of, there's various asset classes represented here. So we can see that the ones that are so far above grade are investment grade bonds, and your U.S. U.S. Treasuries are both positive for the year to date. You can see where the other ones, the biggest one is U.S. small equities are still down, just about 10% year to date. So lower interest rates for how much longer? So this is December of 18. Of the 2-year Treasury was at at the end of December of 2018, 2.49%. As of June 30th, it's 0.15%. Again, we'll go back to like a 30-year Treasury, 3.01 versus 1.41. So these are not directly tied to mortgages. However, they are a basis certainly that one could use to bounce that off of, and so on and so forth. So you can see where these rates versus at the end of 18 have certainly come down. Again, we think that that's a good thing. If you're trying to borrow money, it could be a bad thing if you're trying to preserve or protect dollars just because of the low interest rate. And then obviously what's happening in Japan, Germany, and the UK. Of note here again is Germany has a negative interest rate. So that's been, they were positive and now they've gone negative. So that's again something that we're just tracking, tracing what's happening not only within the U.S. borders, but what's happening in other countries. So the outlook. So as we mentioned in November, this is an election year. So not that we've not been short on volatility catalysts, but we began the year with a bang. We'll probably end the year with a bang. So the current polls show that Vice President Biden is leading by a wide margin. So we know from the 2016 presidential election and that polls are no guarantee of what the potential outcome is going to be. Of note here is Vice President Biden has proposed raising corporate taxes from the current 21% to 28%, reversing that corporate tax changes that were enacted in 2017. In addition, he's talked about raising taxes on the high-income individuals. So surprisingly, there's one issue that most Republicans and Democrats can agree on in principle. It's a tough stance towards China on trade and other economic policies. So, certainly Trump has his tactics. Biden will probably bring a different tactic to it in terms of how they negotiate with China. But we would not expect, in that case, a complete policy reversal. So, emerging data on new cases, hospitalization, regardless deaths will continue to move markets, and until there's a vaccine, the 90% economy will be the new norm that we talked about before. So we're concerned about a second wave. So the Fed chair put it best when he said, a full economic recovery is unlikely until people feel safe. So that's just a theme running within our firm here is just how do we diligently approach your accounts and balancing risk and making sure that we have things tuned up, and we appreciate the conversations along the way as your thoughts and views change along the way too. So obviously we'll focus on the upcoming weeks and months, the efforts to reach another deal, another round of stimulus, and also the power of ultra-low interest rates will continue to be a dominant force and supportive for the equity markets. So again, the theme here is there's a lot of moving parts, subject to change, as we know, nearly on a daily basis. And that's what we're charged to do, is to be aware of those, but also appreciate taking times like this just to kind of bring you up to speed on what we see happening out there. So we talked about that 90% economy, and we talked about in there the tech companies that were mentioned. So I thought I had to do is really talk about what is the impact or what are the size of some of these big tech firms, and some of them that you can imagine, have ballooned in size here. So the big 5 tech companies, which I'll explain in a minute, generate almost $900 billion of revenue. So that's about the same GDP as a company like the Netherlands or Saudi Arabia. And there's other countries out here we've looked at, but again, Facebook, Apple, Microsoft, Amazon, and Alphabet are just under 900 billion of revenue, which again is the larger than Saudi Arabia and just a touch under what the Netherlands is at. So when we think about these big companies, one of the things we can do is zoom in to where are the sales coming from. So as an example, with Amazon, which is now a $1 trillion market cap company, which is pretty crazy, 50.4% of their revenue comes from their online stores. And you can see there where their other revenues are coming from. Subscription services are just under 7%, and Amazon Web Services at 12.5%. You juxtapose that to Apple, and a lot of people wonder, well, how does Apple make all their money? Well, 54.7% of their revenue comes from one device, the iPhone. And so that's why it's important, obviously, for them to keep pace with that technology. They're certainly a technology firm. Apple is as well a $1 trillion firm at this point. Alphabet, so this is, think of Alphabet Google. So 70% of Alphabet's revenue comes from the advertising services like Google, YouTube, Gmail, and the Google Play Store, Google Maps. And then obviously there's other Google advertising and cloud services and that type of thing. But again, they are a $1 trillion firm, 162 billion of revenue at this point. And then Microsoft. Again, they have a little bit more diverse income stream, but the majority of it comes from the Microsoft, the server products, as well as the Office, as you can imagine, and then the other devices. But what I think is quite interesting here is their revenue, 51% comes from the U.S. and roughly 50% come from the rest of the world. So they're kind of a 50-50 company in terms of their region and where they make their money. So certainly these are companies that are not purely focused on the U.S. And we have to pay attention to things like what's happening in the rest of the world, because that will dictate obviously their revenues. Microsoft as well as a $1 trillion company, and then Facebook, which is our fifth one, and they are not a $1 trillion company yet, but 98.5% of their revenue comes from ads. So for those of you that utilize the services of Facebook, obviously you do not pay for it. However, there's a lot of ads that probably pop under your nose as you're going through your accounts. So again, a lot of the big companies have grown to $1 trillion market capitalization firms. Like we said, there's now 4 out of the 5. So they have very different cash flow breakdowns and trajectories. Some of them have diverse mix. Some of them are pretty limited in scope. That's one of the things when we've gone through growth in almost every segment, but big tech has eclipsed big oil and other major industry groups that comprise of the most valuable publicly traded companies in the world. And this is a far cry from the difference of what it used to be, if you will. So the growth comes with difficulty. Data use, diversity, treatment of workers, and all have become hot buttons on a global scale. So putting the big tech on the defense with advertisers and governments alike. So still this hasn't stopped the tech giants, at least all of them, from posting massive revenue growth here recently as well. So again, I submit that to you, just the power of these 5 companies. If you think about the value of them from, if you equate it to the GDP of these other companies, it just tells you the magnitude of what it is that they do on a global scale. And certainly all of these companies are U.S. based and have a decent size of the revenue comes from the U.S. as well. Kind of looking at what happened recently. So this is a difference. This is a comparison of 2018 revenue versus 2019 revenue. So you see Apple is the only one that did not go through a growth phase between 18 and 19. The rest of them had more than double-digit growth. Amazon notably at 20.44 and Facebook at 26.88. So we'll be interested to see what happens again in 2020 at the conclusion here. But Apple, again, the revenues and the market cap, so between 19 and the net income of 19, again, with Facebook being the only company that's left in the billion-dollar mark versus the trillion-dollar mark. But you can see the net income in these is pretty impressive, particularly when you look at like Apple, Alphabet, and Microsoft. So when you have companies that are bigger than countries, obviously that's something to take note of. These are some of the most researched and obviously companies that are dug through on a very regular basis. But iPhone revenue is still the cornerstone of Apple's business, but it dropped by almost $25 billion. That offset almost $10 billion increase in revenue from services and about $3 billion from iPad sales. So again, when you look at a company like Apple and then you investigate or kind of zoom in to where is their revenue coming from, obviously if they come out with a new iPhone and everybody goes and buys it, that's a really good thing for Apple. Thanks again for joining us.